Since you are willing to study and learn about personal finance, you are interested in making plans for financial security. You want to know that if you defer some spending, make some sacrifices, and save some money, it will be worthwhile. As you grow older and build a career, perhaps get married, even have children, you become more interested in the future and the money you need for it. What's a four-letter word for what you can do to help? Of course. But there are ways you can save, and some are more suitable than others for your individual situation and the national economy. What are some factors you think you should consider? Yes. You should consider your probable needs, both in the near future and long run, the probable risks you can accept in arranging your affairs and investing your money, and the amount of return you can expect in the form of interest or dividends or appreciation in value. You could bury some money in the backyard in a tin can. Some persons actually do something like this, and when they need cash, they can get it. Do you think most people should do this? No. There are some risks, and there is no investment return, just inflation losses. Probably a straight bank checking account is better, or even a Now bank account, which combines checking privileges with a low interest earning rate. Now means negotiable order of withdrawal. Now accounts earn interest and are subject to some charges and minimum balance requirements. But unlike passbook savings accounts, which also earn at low rates, you can cash checks against Now accounts. What does Now stand for? Right. Your decision as to whether, how much, and how you save must be based on your goals. You may put something aside for a rainy day, save up for a trip to France next year, scrimp for that country home, invest for the children's college education, or prepare for retirement. Different goals suggest different saving and investing plans, and you may have several short and long-term goals at once. Other programs in this series discuss in more detail the goals like retirement and some means like stocks, bonds, and funds. For relatively short-term purposes, you'll probably save in some sort of savings account in a bank or a savings and loan firm. What do you think you might use for longer-term savings purposes? Yes. More on that in the next program. Now let's talk about the banker's secret. This is that although 5 or 10 or even 15% is not much of a total amount, when it is compounded, it grows at a surprising rate. You recall the 12% per annum compounded doubles an amount in only 6 years. Of course, you will likely not receive 12% after inflation as a safe return on your savings. But a modest amount, saved each month, invested at the best safe interest, can in 10 or 20 or 30 years amount to a substantial sum. What kind of savings program will this meet? Right. But of course, you also have short-term objectives, where more liquid, that is, easily convertible to cash, savings are needed. Single passbook or now savings accounts will serve this purpose. However, interest earned at low rates for short periods, a year or two, make little contribution to meeting short-term objectives. For these, you might say it's the principle that counts. Savings institutions have recently emphasized small differences in interest rates, even though each kind of an account can offer only a government-controlled rate. This is because they may compound quarterly, monthly, weekly, or even continuously instead of annually. For which kind of goal is interest rate important? Right. At low interest rates, there's little to be gained by frequent compounding. A 5% annual rate gives only about 1/10% more when compounded monthly, or 1/8% more when compounded continually. But at 15%, monthly compounding gives over 1 full percentage point more than annual compounding. In passbook or now accounts, there are also several ways of computing your balance on which interest accrues. The most interest is usually paid when the actual daily balance is calculated. Which compounding period pays highest interest on savings? Right. You can keep money in savings accounts in regular commercial banks, savings and loan associations, and credit unions. Many persons find it handier to keep savings accounts at the same place as checking accounts, but don't expect to have funds transferred from savings to checkings to cover overdrafts unless you've made prior arrangements. Recently, ordinary savings accounts haven't even kept up with inflation. There are, however, ways to get more interest and with little risk. One higher interest way of savings is by certificate of deposit, which you can make for a fixed time. This may be 3 or 6 or 12 months or even longer, and at a fixed rate. Banks and savings firms have these for $100 to $100,000 and more. What do you think these certificates are often called? Right. CDs have in recent years paid substantial rates. For 6-month deposits of $10,000 or more, banks and others may pay on these money market certificates a little more than the weekly auction price of U.S. Treasury bills. About what was this back in 1981? Yes. Money talks. And if you have $100,000 or more, you can speak to your banker or other institutions and get whatever interest you can negotiate. Such certificates are called negotiable CDs because they can be transferred or negotiated before maturity. Of course, you can also buy U.S. savings bonds, which are government securities. Series EE and HH bonds have recently paid 7.5%, and EE bonds have a college education tax shelter feature. would you describe a $100,000 CD? Yes. If you have $100,000 or more, there are several relatively liquid savings instruments which can be easily converted to cash, including U.S. Treasury bills and notes. The factors which would affect your choice are convenience, small rate differences, and recent money market shifts. A Treasury bill is just a short-term note, usually for 90 days. Treasury notes may be for up to 5 years. What is the four-letter name for another long-term debt instrument or security? Correct. You will learn more about stocks and bonds in the next program. These securities, or investments, are for long-term needs and for greater returns at greater risks. How would you save for next year's trip to Disney World? Right. For short-term needs, you want liquidity, security, and convenience, and will settle for modest profits. For intermediate and long-term needs, you may consider common and preferred stock, corporate and government bonds, or several kinds of indirect investments such as mutual funds and retirement plans. A traditional savings goal for middle-income Americans has been for children's college education. How would you classify this savings objective? Yes. We would probably say that it's a 10 or 12-year plan with low to moderate risks acceptable and with medium rate earnings desired. How much do you think you would save if you put $50 per month in a 10% interest savings plan for 10 years? Yes, $10,242. In recent years, government loan programs and state-funded universities have made it less necessary to sacrifice as much for children's higher education, but it remains an important intermediate goal. What are some others? The key fact which you must remember about long-term investment is that much of the dollar sum you finally get will be interest, dividends, or capital gains. So you need to maximize this at reasonable risk. At the same time, remember, you must minimize something else. Yes. And remember, the largest investment many families make is for their home. A home investment, however, is unique in that it is partly an investment and partly a consumer item, and for various reasons, it presently has special tax advantages. In another program of this series, you will learn about factors to consider when saving for retirement. For social and political reasons, some savings plans for this purpose have special tax advantages too. Many persons enjoy taking risks with money and may even be compulsive gamblers. Others have obsessive fears about risks and will keep savings only in cash or low-return accounts. While no one can be absolutely sure of anything, you should probably have what kind of savings plan? Yes. Of course, you may be sorry you didn't get computer genetics whiz because your neighbor said he did and cleaned up, but then maybe not. Such an investment may actually be part of a balanced investment program or a mutual funds portfolio, but it should be a limited part. In a free capital market, which the U.S. market largely is, there is considerable efficiency. Market efficiency means the price or earnings rate pretty well reflects an informed consensus of current risks and value. So what is your primary investment concern? Yes. Of course, your values may lead you to subordinate some of your personal needs to help your church or to support a worthy cause. In fact, recent research has shown that a primary goal of sacrifice and saving is for bequests to children rather than retirement and luxury. You could essentially use up your assets in retirement by reverse mortgages on your house and by purchasing an annuity, which is a sort of reverse life insurance which makes payments to you as long as you live. As helpful as they are, you can't expect to retire on Social Security payments. And, because of birth rate shifts, those payments may be even more limited in the future. What can you buy for $50,000 when you're 65 that will pay $500 a month only as long as you live? Yes. It's hard to give the proper weight to different savings vehicles so you can add them up. In pension plans, for example, a dollar is not just a dollar. It may be nothing if it's not vested and you change your employer. Or it may be worth more than another dollar invested without the same tax exclusions. In the next 3 programs, you'll learn something about stocks, bonds, and mutual funds. They can help you reach your goals. Good luck.